market trends are beautiful. I'm not asking you not to use them, but what I'm saying is that be careful to know when to use them. Remember, all these things are assumptions. Your underwriting is based on a pro forma. That's it. So if you know it's based on a pro forma, it's an assumption, you need to find out what exactly the market is doing and what are the projected plans for that market. Welcome once everyone again to Ask the Multifamily Expert, and today we'll be talking about what actually is the market trend and what actually is the market fundamental. Because sometimes there's a misunderstanding between both and we see people buying properties in a very wrong way. And that's one of the reasons why we have some properties that are undergoing foreclosure or about to be foreclosed. And it's just because they relied on one of those things I just mentioned rather than the both. Because you need to match both of them for you to be able to get a deal. So today we're going to break down what market trends are, and if you see them, you should know that they are market trends and they have a short time span. And we also break down what are market fundamentals. These ones are long term, they don't change. They are the fundamental and you have to rely on them. So we are going to discuss that today. But before I go into that, I would like to introduce myself to those of you that do not know me. My name is Bibi Ofiri and I am the host of Ask the Multifamily Expert. I also co-host on another platform, and that is asset management. For those that are interested in knowing about how to manage an asset, we really talk about that. On that platform, what we are already talking about is the A to Z of multifamily syndication. So if you're looking at syndicating a property or you're looking at starting a multifamily through syndication, I would recommend that you attend our series. We started it last week and we are thinking hopefully we can wrap it up by December. So if you've not gotten on board on that, go right ahead and do it. For those of you that have not subscribed to our YouTube channel, I would say that you are missing a lot because the conversation continues there. That's a platform where we get to see some things that maybe we might have missed out in a live event like this. We always go back there, redo the videos and post out, and it's absolutely free. For those of you that are not aware, when I started my multifamily journey, I didn't have a dime and I used a lot of YouTube content to learn. Not all, because there's so much garbage on YouTube, so it's not everything you should listen to. But that was how I started before I was able to start my multifamily journey. So I would recommend that you subscribe to it. The barcode is there. We're going to leave it here for a bit before we take it down. So I'm going to talk about what our agenda is for today. Today we'll be talking about what market trends are and how not to get burnt by them. And the second one is what market fundamentals are and how to spot them. And the last one is how to balance both on your deals so that your deals can start printing money. So those are the three things I hope that you'll be able to take home with you by the time we end this. So for those of you that are here to ask questions, this is Ask the Multifamily Expert. At any point in time, you can type in your question, and because it's a segment for asking questions, I'm obligated to answer them and continue my conversation. So please make use of the Q&A that you see in front of your screen. Make use of it at any point in time. Interject. You can raise up your hand. We can call you to the panel to join us. Please don't hesitate to do that. Okay, now let's start. What actually is market trend? Because most of us hear market trend, but we don't understand what it is. Market trends are things that shift maybe in a short period of time. When I make an example of them, I'm sure you'll be able to understand exactly what they are. There are things like interest rate cuts. There are things like job cuts. There are things like a developer, maybe inventory has just stormed the market. When I mean inventory, that is new construction have come to the market. Those things are short-lived, and if you are buying just because of those little bubbles, then you are making a mistake. So let me give an example of what that might look like. I did a video recently about quantitative easing. Quantitative easing is one of the tools that the federal government uses. Sometimes we are not aware of it. They do it sometimes in a very low tone, sometimes very loud. They do that to stimulate the economy, and once they are doing doing that, you see that interest rate is going down. And if you are not aware or you are not looking at the market, because that's a market trend, it's short-lived. It's just for a period of time. They are trying to reduce interest rate to just stimulate the economy. Once they've done that, they'll start doing something called quantitative tightening. That means they'll start pulling back the money from the economy, and the economy will start tightening. And one of the ways they get to pull money out is by increasing interest rate. So if you are buying a property and your assumptions are wrong, you are relying on the Fed always reducing interest rate because they started reducing interest rate now, that might be a bubble and might bust. Something similar happened during the pandemic. So let me explain to you what happened in the pandemic. Most of the people that we are seeing that had their properties foreclosed, well, it was not because they were not experienced or because they've not had so many properties under their belt. Most of them happened because they failed to recognize the difference between market trend and market fundamental. So what they were looking at was the interest rate reducing. Interest rate in 2020 and 2021 was zero. That is, the 10 years treasury was giving us interest rate at 2 point something because the Fed was at zero. So the 10 years treasury would either give you a 2.5% interest rate or 3 point something, depending on the lender you're using. Based on that, people were buying properties at that point, and they were assuming that when they decide to sell, interest rates will remain as it is or might be maybe 4%. So imagine you buying a property and you bought it at 2.5% interest rate in 2020, and your assumption is that in 2024, if I decide to refinance, that property I'll refinance at maybe 3.5% based on what you bought it. You bought it at 2.5. You're assuming that maybe if I'm refinancing, it might be 3.5. That was a mistake so many people made, apart from other mistakes. So now we found out that come 2024, interest rate was now at 7%. So if you have done your underwriting and you were stopped at 3.5%, your deal alone is gone. You know that your deal has failed. So that is when you see when people are depending on market trends. Market trends is not a standalone. The fundamental is like the concrete, like the foundation that you must build your deals on. And the market trend is like the add-on, like the roof, the pillars, the flooring. Those are like market trends because those things can easily be changed. Like you can change your flooring, you can change your roof once it's damaged. But your foundation, when you have a foundation issue, it's difficult for you to correct that. Yes, you can correct it, but it's very, very difficult. Market fundamental is even way worse. If you miss it, you might find yourself in difficult situation. So that is market trend. I hope that was able to explain to you what market trend. They are short-term lived. They are opportunities. They are things that once you see, you take advantage of them, but don't make your assumptions totally rely on them because they are just bubbles and they will be ready to burst in just a matter of time. The second one is, what are market fundamentals? So I'm going to give you an example of this because we are currently going through this in one of our deals, and there was a question that one of my partners asked yesterday, and I want to be sure to explain to as many of you that are here what that looks like. Okay, so market fundamentals are like the bedrock on which you need to buy a property on. So for example, market fundamentals are things like job diversification. That is, wherever your market is, you need to ascertain that you have different employers in that market. That is, the market is not reliant on just one employer, like military. I hear some people going to go and buy properties near a military zone, and 80% or 90% of the jobs there are military. That is a deadly decision because if they call them to bases for something, you find out that you lose almost all your tenants because most of them are military people or their families or something. So one of the market strong fundamentals is you need to identify a market that has multiple employers, not just one, multiple, so that in case something happens to one sector or one department or one of the employers, it's not affecting another one. Like if something happens to manufacturing, you know that retail is still going on. Like what we are seeing now, like if you look at the job and employment rate, if you look at the statistic, manufacturing is one of the ones taking the highest blow. So imagine a state where it's just manufacturing that is going on there. You know that you are in for a big soup. It's going to be a big issue for you and all that. So you need to look at that. The second fundamental that you need to look at, very, very important, are the wages, right? How much are people earning? What are they being paid? Because there's a standard, a requirement that people should not spend up to 50% of what they earn. It's not sustainable. If I make 3,000 and I'm spending 1,500, there's a tendency that it's only a matter of time. I will not be able to cope and I will leave, or I'll go to another state, or I'll go somewhere else that I can afford. So it's not a sustainable thing. It can happen for a period of time, but how long not really happen. You need to identify how much is the market paying, how much are the workers they're being paid, what's the average. So when we always talk about the average income, household income, very important, that is how we determine if they can actually pay you rent. Like for us, our property management standard is 2.5/3x. That is, whatever you earn must be 2.5 times what your rent is. That is it. Whatever it is you're earning, your income must be able to sustain it. That is, your income should be 2.5 times what you earn. So let's say your rent is 4,500. That means you must be earning 11,250 for that to happen. Or if your rent is 1,500, you must be earning at least 3,750 for you to say that you are fit. So these are things that people do not even look at. Before you rent out, ensure that the general market, your local market, they are earning at least 2.5 times to 3 times their monthly income. Very, very important, because in that way, it's going to be sustainable. That means they can pay. That means they're just using a fraction of their income to pay for rent, and they can decide to stay longer. Another thing is long-term occupancy rate. So another thing we get today is not just the property's occupancy. We do a market survey that shows us what the market is doing. What is the average occupancy in the market? It's understandable that the property you're buying might be 98% and the general market is at 90%. You need to understand why that is happening. Is it possible that the person you're buying it from is putting every Tom, Dick, and Harry to make the property look attractive? If you are moving because you're buying a property because the property you're buying is 98%, the question you should ask yourself is, what are my competitors doing? Let's say I put apples to apples. This is my property, this is another similar property, and this is another similar property, this is another similar property. What are they doing? Is their property management efficient like mine and all that? So if you go around your market comparables, that is your competitors, and you find out that the average is 92% or 90%, that is exactly where the market is. That's what you should put your occupancy to be, because it's possible that when you buy it, reality starts to check you, because the market can only sustain 92%, whereas you bought it at 98% because the seller brought in every Tom, Dick, and Harry to your property and all that. So that is one. So let me give you an example of how we experienced that on some of our deals. So one of our deals, the property was at 98%. Some of you have heard the story, but let me say it again because I like to use it because it just checks out the box. Some of you know that we bought a property that was about, I think, 68%. Yes, it was 68%. It looked like the property was bad because it was formerly foreclosed. So if you're buying that property, you'll be weary and say, okay, this property was once foreclosed. Right now it's at 68%. That is, it's trending towards another foreclosure. You might be weary and say, I'm not buying it. But guess what? In short, we had to look deeper. We had to go to the market to find out what are the market fundamentals. Does this property check all the boxes? So we went to check the wages. We found out that average income was about $70,000, between $65,000 to $75,000. That is, that's what they were earning. And our rent was literally $1,400. That means the market could sustain our rent. That was market check one. Who are the employers? We noticed that a lot of employers were there. We had the medical, we had the construction, we had the manufacturing, we had the retail, all of them. We did a pie chart about those markets and we found out each of them had different sector of the market. That means they occupy different sectors. That means the market was not reliant on one employer. It had multiple employers at a very fair percentage. So that was check two. We checked that box. The other thing that we did was the occupancy. We went to do a market survey. I did this myself, guys. I had to do boots on ground. I went to properties 3 different consecutive times before we were sure that this was the right deal for us. So I was going at different stages. I went in February. I think I went again in April. Then I went again in August. And all the period I went there, I was going to all these properties to see if it was not a fluke, if it was for real. So I was checking the occupancy and consistently they were at between 95% to 100%. That means that market checked the box. That was it. So we now looked again. It checked all the market fundamental. What exactly is wrong with this property? Why is this property at 68% when it has the potential to become good? That was why we bought it, because we knew that as long as the market is at this level and the property we're buying is at this level, that means there was one major problem: the management. That means whoever was managing that property was not doing a good job, period. Because we knew that that was an opportunity we spotted on the go, and that's why we bought it. And come to think of it, now the property is between 94 to 95% according to what the market is, right? But we needed to do the job for that to happen. So that's one thing that you need to take cognizance of when you are buying a property like that. So another example I want to give to you, currently we also have another deal. This deal, we literally have a lot of industries boundaries around the property. That means it checked the bucket of multiple employers. The second one is it has the wages. That means the tenant can sustain the wages on the property, because our standard is they should earn about 2.5 times that. So during the lease audit, we found out that majority of them earn that amount. So that means it checked the box of income. That means they can pay their rent on the property. The third one that we did was, what is the occupancy rate in that market? What are our competitors doing? We found out that other competitors were above 90%, between 90% to 98%, all of them consistently, aside from the one beside it, because there's another property beside it that is owned by the same seller that is underperforming compared to the market. So we knew that this property is a good one, but it's lacking so many things. Like, it's lacking operational experience, that is bad property management, seller's integrity, that is the seller has no integrity at all. The seller is almost like a crook, pieces to just bring in every Tom, Dick, and Harry. So while we were under contract, we realized that we did a lease audit during the due diligence part. And during the due diligence part, what we found out was that some of the tenants were bad tenants and we're going to take them out. But majority of them were good ones. That is, they fell under the market fundamental. But while we were under contract towards closing, the seller, this was what he did. It was a fluke. He brought in every Tom, Dick, and Harry to make the property almost 97%. But we saw that happen. We always monitored the market, even while we were under contract, even after the due diligence. I mean, we always monitored the property we are buying to know exactly what is the shift. Can you break it? We found out that just a few weeks to our closing, the seller has brought in about 17 new people. And when we saw the 17 people, that is about 3 weeks towards our closing, that happened. We noticed that the seller has brought in 17 new people as new tenants. We knew there was something fishy. We immediately called to see the lease agreement. The seller was not cooperative because he says, you've not bought the property, so I'm not obligated to do this. You've done your due diligence, so you're not going to do a second due diligence. Yes, the seller might be right by saying that, because the PSA is very clear that you have access to this during the due diligence. You also have access to some things after the due diligence. But in the PSA is purchase agreement. For those of you that do not understand what that is, PSA is called purchase agreement. So it's like a contract and you must follow through. So depending on what you have on the contract, that is the limit on what you can do. So immediately that happened, we as the buyers, we knew that there was a problem. But the reason why we said we'll go ahead with it regardless was because that's like a fluke. The market supports this property in the sense that the market are doing to this capacity. That means our property would be able to do that. But it's just that it's going to take a little more work because some of the tenants were not there when we did due diligence, and these ones, they might be bad tenants. Lo and behold, we closed. We did another form of lease audit because now we own the property. We found out that those people that the seller brought, all of them are bad tenants. So what we are doing right now is we're evicting them. So now all the new tenants are following our requirements. In the last 1 month, we had about 53 traffic, but out of the 53 traffic, we were able to only pick only 4 people. So we are very diligent about doing that. We don't want to cause a second problem. We are following the market fundamental. As long as the market fundamental is right, then we're on the right track. So I want you to understand this, that market fundamental is where you should rely on the most. And when you see market trend, you take advantage of the opportunity, but don't rely on them. So for us, imagine if we have an opportunity, we underwrote the deal. Let's say you underwrite a deal that you're going to exit in 3 years. When I mean exit, you're going to either sell or refinance in 3 years. What a market trend can do for you. Let's say you bought it right, you follow the market fundamental, and you underwrote the deal that you want to exit in 5 years. Let's say you underwrote it to exit in 5 years. Let me tell you how a market trend can play in your 5-year assumption. So let's say in year 3, interest rate goes down and you don't have a prepayment. That means you don't have any penalty if you decide to sell the property or you decide to refinance. If that's the case, or if you know that if you refinance, maybe you're paying the bank about 1% penalty and it's not going to break the bank. If that's the case, you might want to take advantage of the market trend. That is, it's possible that that opportunity might not sustain itself to the 5th year. The 5th year is when you intended to sell or to refinance. But come the 3rd year, you found out that interest rate is low and I can literally exit. I'm not locked in on my loan. Maybe I'm only going to face a 1% payment penalty with my lender. That might just be a sign for you to exit, because it might be a one-time opportunity during the lifespan of your deal for you to get a lower interest rate. So market trends are beautiful. I'm not asking you not to use them, but what I'm saying is that be careful to know when to use them.